Welcome to AC Spencer Trades. Today we are going to go over liquidity. If you do not understand liquidity, trading 2026 markets or any market whatsoever, you simply will not be profitable. Now this is the reason why markets move. Markets are constantly searching to find fair value, right? And they do that by searching for liquidity and seeing whether buyers or sellers show up at a given level. So liquidity is absolutely everywhere on the chart. You will see it all of the time, and that is the areas where price is reacting. You will always see a reaction there. Sometimes you will see a reversal and sometimes you will see a continuation, depending on whether the market sees that liquidity zone as fair value or whether it sees somewhere which is overpriced or underpriced. So I'm going to take you through exactly how you can find liquidity on the charts and how you can actually implement that to generate some really nice profitable trades. So liquidity can be found in a few different areas, right? You can find it at high time frame highs and lows. You can also find it at session highs and lows, and these are the two main places that you're going to find liquidity. Now liquidity, it will always rebalance to an area where it wants to seek if there is fair value. So this is called imbalance, right? And some of you guys will know this as a fair value gap. Now, a fair value gap is important because there was not much money traded at that level. So if you look at this on a volume profile, which is much more inquisitive and gives you much more detail than just looking at a fair value gap, you will see that there was not many participants showing up at this level. So price needs to go back to it to test whether this is a fair value, which is why it's called fair value gap, to see whether buyers or sellers show up at that level. So liquidity, if we're looking at a chart here, so we're in an uptrend, right? And it seems to be running really nicely. Now, the average retail trader is going to buy into a position here. Now, this is dangerous because you are in a position where this could be a sweep of these highs here and then a move back down, taking this liquidity. So you've got liquidity here, you've got liquidity here, you've got it here, you've got it here. Every high and every low on a higher time frame being 1 hour and above, you've got liquidity. What is liquidity, right? It simply is buy orders and sell orders. Now, the market has to go and test these areas. Retail traders will say it's to trap people, right? This is bullshit. It is not to trap people. You're not, the market doesn't move like that. The Forex exchange, retail traders make up for less than 1% of the exchange which happens on foreign exchange. The market makers do not care about your stop loss positioned here, right? They care about seeing whether big institutions are wanting to buy or sell at this level, right? And that is where you see a liquidity sweep. It's got nothing to do with your stop loss position. They cannot see your stop loss position and they simply do not care about your £1,000 stop loss, right? It is completely irrelevant when there is trillions of dollars being traded through these exchanges every single day. So when people call it a manipulation, it is just straight up bullshit. Do not listen to them. It's retail mindset and it is not realistic, right? So if we come and actually look at this inside of the charts, we can see that this happens all of the time, right? Okay, I mean literally all of the time. So what are we in here? We're creating an uptrend, right? We're creating higher highs and higher lows, okay? Now, if we break this down and look at liquidity, we've got liquidity here, we had liquidity here, 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 here. All of these highs and lows have got liquidity at them, right? So when we're moving through this, let's go one step at a time. So we come up to this high here. We've got liquidity resting down here, which doesn't get touched. Now, what we do is we pull back down, right? We've got this candle here, which creates this pullback, okay? So what we see from there is price comes back up, takes the liquidity above this level, reverses and takes the liquidity down here. So you've got two liquidity sweeps, manipulations if you want to stoop that low, and then we see the continuation because price, we can see that the market is not happy trading at this level and there are buyers showing up at this level. So yes, stop losses will have been placed down here. People would have been taken out of their position. But the main reason for this move is because price came up here, didn't find fair value, came back down here, couldn't find fair value, and then pushed higher. Right? So now we've come up, we've left liquidity down here. So you've got fresh liquidity, which is generated at this level. You move higher, liquidity gets made. What happens? A sweep of that high, price pushes down, take this liquidity down below. The whole time market is moving, it's moving between liquidity levels and seeking fair value. Look, what does this pull back into? A fair value gap here, right? A gap between the three candlesticks. There's no wick which combines in here. So it comes back, seeks fair value, doesn't find it there, comes back up, sweeps this high, also inside of a fair value gap, right? Then moves lower again, takes this liquidity, tests this level, buyers show up, we push higher, we take this liquidity. The whole time the chart is moving, it's taking liquidity, literally all of the time. Now, if you don't understand this, you will never be able to trade financial markets, okay? Because it's literally happening all of the time. So again, what do we see? Price moves higher, we make a low, we create a new high, liquidity is at here, liquidity is here. Price comes down, takes this liquidity, doesn't find fair value and dumps off, right? Where does it dump into? A fair value gap, a very, very big one. Right, then we move higher, we move back down, and then we fill this gap and we're hunting again for liquidity, right? So we move higher, we take this level. That's what this candlestick is doing here, is taking out these highs. Doesn't like being there, so we move back lower again. And then we move higher into, of course, a higher time frame fair value gap, right? We've got a 1 hour fair value gap which arises here. Then we move lower. What do? We come to the most recent liquidity level, we sweep it, and then we move higher. It literally moves from liquidity to fair value. That is all the chart is doing the whole time. So if you can understand these two concepts, you will be able to trade without an issue. Now, once you understand these concepts, it's all about just building a strategy around these two concepts. Where do you want to be getting in? Where do you want to be getting out? Now, the best place for you to be getting in is after a sweep and after searching for fair value, okay? So what we've got here in this fair value gap, price comes back to it the first time, right? Okay, we fill it, okay? We move higher, we take out this liquidity, right? We've just been through that. Now, what we're looking for is for further liquidity to get swept. We get that down here, and then we see the big move, okay? So we've come down, we found fair value, we've swept liquidity, buyers are showing up here, institutions are buying, and that is where the big moves come. Now, to trade this really well, you want to be dropping into a lower time frame, okay? So coming into the lower time frame, we need to mark up where that low is. This is the 1 hour low where we're assuming there is liquidity resting below. We can see that that has now happened. So what we have to look for on this leg down is a fair value gap. Now we can see that there is a gap generated here, and it did break out from this gap here for the first time. But we have not swept the higher time frame liquidity at this point. Once price breaks that higher time frame liquidity with a nice strong bullish candle, then you can put your stop loss below that bullish candle and simply target back up to the liquidity which is resting above these highs right here. Okay, so it's very simple. You're moving from fair value to liquidity, and the market does that time and time again. So let's find another example. Okay, so this time we're in a downtrend, right? We're making lower lows and lower highs. Now, what we get at this position here is a sweep of that higher time frame liquidity into a 1 hour fair value gap. Yeah, you can see that price is clearly sweeping these highs and entering this fair value gap here between this wick and this wick here. Now, that is the perfect time for you to get into this position. So then we drop into the lower time frames and we're looking for that inverse fair value gap, okay? So if we can find this back on the chart, we come over to here. Now, what we can see is the 1 hour fair value gap had not yet been filled, okay? So we're looking for that confluence to get into this trade. Now, the top of the fair value gap sits around this level. We can see that our 5 minute fair value gap sits across here. So what we can do is we can enter into a short position as soon as we get a break of that level, with the stop loss coming in at the top of this fair value gap. So if we come back out to the 1 hour chart and we mark up the top of that fair value gap, this time with a straight line, we can see comes in here, right? Back down onto the lower time frames, stop loss above that level, and then we can target all the way back down to liquidity. This is a liquidity level because it's a swing low of a higher time frame, right? So we're happy that price is going to come back down to that level to find fair value again, and that's exactly what it does, and then just continues even further lower. Like, this is happens on every single time frame, right? If you're using the 5 minute time frame as your higher time frame, that's fine. You just need to drop into a 30-second chart to get your entry. Look, a sweep of these equal highs here. There is clearly liquidity resting at this level. There's going to be stop losses here, and people, the market makers, are looking to see whether buyers or sellers show up at this level, and quite clearly sellers show up. We get a big rejection candle from here and then a clear continuation back down to another level of liquidity. And what do we see price pulls back into here? A fair value gap, a 5 minute gap. This is literally all you need to generate profit this year, is understanding liquidity and understanding fair value. If you can understand these two things, you will generate a profit. Now you have to just go away and build this into a trading strategy, which is going to be in the next video, which I drop next week. So make sure you've got those notifications turned on. Make sure you subscribe, give it a like, and comment exactly how you found this video.